So you've probably heard of a target date retirement mutual fund. It's a single fund that you can invest in to save for retirement. You pick it based on the year you think you'll retire. In fact, they'll even put the year in the name of the fund so you know which one to pick. And then you're done. They make it a little bit more conservative as you get closer and closer to retirement by shifting some of the stock investments into bonds. They do that for you. And you can simply save into that one fund and keep doing that until you're ready to retire. But then what happens? Now that you're in retirement, are there single mutual funds or ETFs that you can use to invest all of your retirement assets once you retire? Well, that's what we're going to cover in this video. I'm going to give you some ideas of some funds to consider and types of funds that you could use in retirement, just one fund to manage all of your money. And that's true whether you've got 100,000, a million, or 10 million. So that's what we're going to do in today's video. And so let's get started. The first one I want to show you, this actually comes from Vanguard. Now, we have to make sure we get the terminology right. Vanguard calls these life strategy funds. The term life strategy is just a branding or marketing term that Vanguard has come up with to describe these mutual funds that I'm going to show you. In the industry, these would be called asset allocation funds. And the idea behind them is they're going to invest in both stocks and bonds in a certain allocation, meaning a certain percentage of each, depending on how conservative you'd like to be or how aggressive you want to be. And fund companies that offer these asset allocation funds usually offer 4 or 5 different allocations that you can pick from. In the case of life strategy funds, we can come down here, we see 4 of them, and you can see the allocation over here. So for this one, Life Strategy Income Fund, if you can put all of your money in this fund, or every dollar you put in here, Vanguard will divide it up, put 20% of it in stocks, and 80% in bonds. And of course, then if you say, well, that's a little too conservative, well, you just can come up to the next one. They call it the Life Strategy Conservative Growth Fund. You get 40% in stocks, 60% in bonds, and then they've got Moderate Growth, which is 60% stocks, 40% bonds. That might be a very popular one for folks in retirement. And Life Strategy Growth Fund, this is the most aggressive they get, 80% stocks, 20% bonds. Now, the thing I want to point out is these funds aren't specifically designed for people in retirement. Someone that's saving for retirement or perhaps saving for something else over a long period of time could use these funds as well. But I think if they've got the target allocation you're looking for, or at least something close, these would be ideal funds to consider once you're in retirement. Now, keep in mind, unlike a target date retirement fund, the asset allocation here, the division between how much goes in stocks and how much goes in bonds, doesn't change over time. It stays the same. So if you invest, for example, in this moderate growth fund, it's going to be 60% stocks, 40% bonds today, tomorrow, and 10 years from now. We can take a look at a specific example, and I'll use the moderate growth fund as an example. We can see it's only 13 basis points. That's 0.13%, very inexpensive. You need a $3,000 minimum investment. And we can actually come down to portfolio composition. And you can see what Vanguard does is if you invest in this fund, they take your money and split it between 4 of their other funds. The Vanguard Total Stock Market Index Fund gets 35.8%. Their total bond fund gets about 28%. They've got a total international stock fund that's around 24%. And they put some in international bonds, close to 12.5%. And now the expense ratio is all in. So they don't charge you separately for the expense ratios for these funds. It's 13 basis points total. And so a low cost, great fund. I will point out one thing it doesn't invest in are tips. So if tips are something that's important to you, I suppose you could, as an example, put perhaps the majority of your money in this fund and then some amount in a tips fund if you wanted to. But the idea behind a fund like a life strategy is you're getting a good fund that you're simplifying your investments. What you're giving up is some level of control. So this is a 60-40 stock allocation with these specific funds used to implement the investment strategy, and that's your choice. You don't have options. You can't say, well, I want 65% stocks and 35% bonds. So you're giving up some level of control in exchange for simplicity. And by the way, that's true with all of the funds we're going to look at, and that's true generally. There's sort of a simplicity and control. You can't have them both. So that's something that you'll have to decide for yourself. Okay, now before we leave Vanguard, I want to show you two other options that are similar to life strategy funds. The first is called Wellington, and the second one is called Wellesley. These are two of the oldest mutual funds still in existence today across any mutual fund company. I will tell you, these are both actively managed. In fact, you can see it right here, management style active, which means there are people behind the scenes deciding what stocks and bonds to invest in for these funds. That being said, unlike most actively managed funds, these are incredibly inexpensive for an actively managed fund. This one's just 17 basis points. This is Admiral Shares. It does require a $50,000 minimum investment. This particular fund, we can go down to composition, is roughly 65% stocks and 35% bonds. And then Wellington is just the opposite. If we go back to portfolio composition, it's roughly 35% stocks, 65% bonds. There's some short-term reserves as well. I'm not one to normally recommend actively managed funds or to speak highly of them. There are exceptions. These two have been known to perform extremely well over a very, very long period of time. And so I mention them to you as options. Again, you're getting simplicity, one fund, but you're giving up some level of control. You have to accept what they're investing in and the specific asset allocation that they offer, which may or may not be what you're looking for. But I think these are good funds to at least consider. Again, I'll link to all of this below the video. Now, I want to move away from Vanguard for a minute, and I want to come to iShares by BlackRock. Now, notice they call this asset allocation solutions, which we talked about, asset allocation funds. And they offer them too, very similar to the life strategy funds we saw at Vanguard. And you can see them here. And they've got two different kinds. The one on the set on the right are ESG aware. So if that's something that's important to you, you can look at those. I'm going to focus on their just what they call core allocation funds here on the left. And very similar to Vanguard, they offer 4 of them, and these are the tickers. Now, these are ETFs. Vanguards are mutual funds. As a practical matter, I think, particularly if we're talking about retirement accounts like an IRA, I don't see a significant difference. There can be some tax advantages to some ETFs over some mutual funds. I think in this case, particularly inside an IRA, probably not a significant difference. But you'll notice these are relatively inexpensive at 15 basis points. And if we scroll down, we can see, well, here we go. We can see what the allocations are. So just like Vanguard, for example, ticker AOR, they offer 60% stocks, 40% bonds. But of course, you've got other choices. They've got 80-20, 40-60, and 30-70. And you can come down here and see specifically what they're investing in. Now, Vanguard used 4 funds. iShares uses 7. The blue and light blue are U.S. stocks. The sort of purple and pink and lavender are international stocks. And the green are bonds, both international and U.S. And so depending on which fund you would pick, you can see exactly what they're investing in. Extremely straightforward. Again, you'd have to pick an asset allocation that they're offering. And if it's something that's close to what you want, then it might be a consideration. But I want to point out that Vanguard isn't the only company that offers asset allocation funds. iShares by BlackRock is another example. Now, beyond asset allocation funds, can we still consider a target date retirement fund? At first, it might seem like, well, no, Rob, we can't do that because we're now retired. And target date retirement funds change their asset allocation. Is that a good thing? Well, there are 2 ways to at least consider a target date retirement fund, and let me show you what they are. The first is, and I'm going to stick with BlackRock for a moment, and as I said, I'll link to all of this. This is just a 2-page summary of their target date ETFs. And you can see here, I mentioned that in the names of these funds, and this is true with Fidelity and Vanguard and so on, they put the years in, right? So if you wanted to retire in 2050, well, here's your fund, and you could use that fund. But what about folks that are already retired? Well, all of the different target date retirement funds offered by the various large fund companies include one or more funds designed for once you're in retirement. For iShares, they call it the iShares LifePath Retirement ETF, and this is the ticker. Let me quickly show you Vanguard's. Yeah, Vanguard has something similar. Here it is, Vanguard Target Retirement Income Fund. Now, the thing we have to know, though, let me go back to iShares. Not all of these funds are created equal. The asset allocation from, say, iShares Retirement Fund can be very different than what, say, Vanguard's is. And so you have to look at the asset allocation of these funds to see if it's what you want. Now, we can do that. Here is, let's see, here's the iShares LifePath Retirement ETF, and we can come down here and look at, let me find it. Here we go, close maybe? Maybe not. Oh, here we go. So here's we can look at geography breakdown, but we want to look at asset class, and we can see fixed income is 60% and equities are 40. So it's a 60% bonds, 40% stocks, which may or may not be what you want. I can tell you that I've looked at a lot of target date retirement funds. When you get to that retirement age and you've got the retirement version of their target date retirement fund, they get very, very conservative. Many of them get even more conservative than this one, where the stock allocation is less than 40%. So here you might say that's just too conservative. Does that mean target date funds are out? Well, not necessarily. There is another strategy to consider. Let me show you what that is. If we go back to iShares, and again, I'm just using this as an example, I pulled up their 2035 fund. One of the things that I've said many times is that while this year is designed to help investors pick the right fund when they're saving for retirement, there's no rule that says you have to want to retire at 2035 to invest in this fund. Anybody can invest in this fund, whether maybe you want to retire in 2070 or maybe you've been retired for 10 years. You can still, invest in this fund if you want to. And that opens up a lot of opportunities for us, because we could go into the target date fund, in this case of iShares, or you could pick Vanguard, or you could pick Fidelity, and say, is there a target date fund they offer that has the specific asset allocation that I want? So if we look at this 2035 fund and we scroll down and find the exposure, this one happens to be about 67 or 68% equities and 31 or 32% fixed income. If that is close to the asset allocation you want, or again, you could pick the 2040 fund or the 2025 fund, but if you find the fund and the fund family where the fund has the asset allocation you want, then you could consider a 2035 fund, for example, even if you're retired now. Now, there is a catch. These funds, because their target date, as time goes by, will get more conservative, meaning they'll shift some of the stock investments over to bonds. And so what that means is you're going to have to keep an eye on the asset allocation of this fund, and it may mean every couple of years, maybe every 5 years, depending on how much the fund changes its allocation and what your investment goals are, that you have to then take that money and put it maybe in the 2040 fund 5 years from now, as an example, to get the asset allocation you want. But, to do that once every few years, again, we're talking about inside a retirement account, not a taxable account, where you can make that change without tax consequences. Sure, maybe every 2, 3, 5 years you have to make that change, but if it gets you the asset allocation you want, it may be worth considering. So the last thing I want to mention is this. We've looked at asset allocation funds as an option. We've looked at target date, I'll call them retirement funds or income funds, those funds that sort of at the end of the line where all of your money ends up once you retire. We've talked about that as an option, but again, they can be somewhat conservative. And then we've talked about just using a regular target date retirement fund of some year that matches the allocation you want, just keeping in mind that you have to keep an eye on the allocation because it does change. I want to show you 2 other quick things or ideas. The first is, if you look at some target date retirement funds, you will see them, this is Vanguard, you'll notice They have a Target Retirement 2020 fund. Wait a minute, that doesn't seem right. Aren't we in 2023? And if you go to Fidelity, let's see. Look at this. They have a Target. I don't know if you can see that. It's kind of small. They have a 2005 fund and a 10 fund and a 1015 fund. It's like, shouldn't they be updating their websites? Not so fast. What some funds do, well, they will continue to change the asset allocation as you move into retirement and you start to live your years in retirement. In other words, some target date retirement funds, once you get to retirement, they stop changing your asset allocation. I think that's how iShares works, I think. Others will continue to change your asset allocation into retirement for some number of years, think 5, 10, or maybe even 15 years, and then change or then stop the change and have a retirement income fund that you go into that doesn't keep changing. So I want to point that out. That's why you're seeing some fund families that'll have something like a target date 2010 fund, even though we're in 2023. Again, those might be other options worth considering depending on the asset allocation that fund offers and what you're looking for. The second thing I want to mention is maybe there's some of you that say, Rob, I like the idea of a single fund, very simple, but boy, I'd really like to have more REITs because I really want some exposure to real estate. Or maybe I'm a big Paul Merriman fan. I want some small cap value. Well, you can combine these. You could say, I'm going to put 90% of my money in an asset allocation fund, but I'm going to take that other 10% and put it in a REIT, or 10% and put it in small cap value. Yes, it complicates your portfolio a little bit because now you've got 2 funds instead of 1. But for some of you, that might be what you need to get that exact exposure that you want. Again, whether it's towards REITs, or it's towards small cap value, or maybe it's towards tips because the asset allocation fund you've chosen doesn't offer tips. By the way, some of the target date retirement funds do offer tips. In fact, I'm pretty sure iShares does, although you'll want to confirm that. So you'll want to make sure you understand not only the stock bond allocation of these funds, but how they're investing your money within the stock allocation and within the bond allocation. Again, I'll leave links to everything I've shown you below the video. And of course, if you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. Until next time, remember, the best thing money can buy is financial freedom.